Okay, while this is loading, so I'm going to talk for 15 minutes. My purpose is twofold. One, I'm going to provide a working vocabulary and exposition of the main proximate mechanisms that led to the housing bubble in 2007 and 2008. Second, I want to give a detailed or an overview of the National Bureau of Economic Relations literature that's been published and some other mainstream economic literature, and provide a critique of that literature. And then I'll hand that over to Drew and everyone else. So let me, how do I start this? Just a view. Slideshow. Okay, so here's a timeline, 2007. This is basically to convey the point that the housing bubble began early. We usually think of it as occurring in 2008, but it actually has its roots in 2007. In February of 2007 is when we first noted an increase in subprime mortgage defaults. I'm going to skip the rest of this, but there were some early bank failures in 2007. BNP Paribas, Northern Rock, the first bank in the UK to fall victim to a bank run in over a century. The Federal Reserve announced several federal funds rate cuts in order to increase lending. 2008, this is a timeline and chronological order of bank failures. I didn't put specific dates on some of these because the processes by which they defaulted occurred over a duration of time, sometimes days, sometimes weeks. But you can see that Bear Stearns defaulted first. Fannie Mae and Freddie Mac were placed under federal conservatorship on September 7th. Lehman declared bankruptcy, was not bailed out. Merrill Lynch sold to Bank of America. AIG, which was invested heavily in credit default swaps, which I'll explain shortly, faced severe trouble, was bailed out for $85 billion. A few months later, bailed out for $37 billion, another $40 billion, and it's still counting. Washington Mutual suffers a silent bank run and placed under FDIC receivership, and Wachovia was bought by Wells Fargo. At the end of September, the stock market lost $8 trillion from the peak of October 2007. So I need to go over some of the terms. One of the things that frustrated me in the last colloquium was that I did not have a clear understanding of what all this stuff meant. I was very frustrated by that, so I buried myself in some books, some blogs, and some MBER papers to try to sort this stuff out, and it's actually not that difficult to understand. First is the collateralized debt obligation, or the CDO. I'm going to explain this in the flowchart in a minute, but the tentative definition is a type of structured asset-backed security, ABS whose value and payments are derived from a fixed income underlying asset divided into slices or tranches of varying risk from AAA to toxic waste. Okay, I'm going to explain that. The primary asset that's used to back up a CDO is a mortgage-backed security, or one of the most popular ones. The second is a credit default swap, which is a contract ensuring against the default of a particular bond or tranche. Estimates for outstanding CDSs range from $45 trillion to $62 trillion in 2007. Now, what does this mean? Let me skip that. Okay, mortgage-backed securities. So here's a nice, here's a flow chart. Think of it this way. One, you have a homeowner. He gets a mortgage from a broker or a small bank. This is the small bank or broker is the little circle here. Oh, yeah. So that's the little circle here. So let's say they give lend $1 million. They're going to receive a monthly flow of income, $1 million plus, let's say, 5% interest over 30 years. Now, that bank is now has an asset worth $1 million, and the asset is actually the house. It's the income flow. This is what's been confusing me, because when it goes on the secondary market, it actually, the value of that house is actually detached from that income flow. But think of it like this. I've got a monthly stream of income coming in. Whatever that is, $1 million divided by 30 divided by 12, or 30 times 12. Anyway, so you get a monthly flow of income. I'm going to take that monthly flow of income, and I'm actually going to sell it to another bank. Okay, that's the process of securitization. So the bank sells the mortgage, i.e. the monthly flow of income, to a Wall Street firm or to a larger bank. It keeps going up and up the ladder until it reaches the big Wall Street firms at the top, which collect thousands of mortgages. So you then have all of these mortgages which are bundled up in one package into one big monthly income stream. So the credit default swap actually complicates this a little bit because the firm, let's say firm B, which is an independent firm, will sell the insurance to firm A in the form of a credit default swap. And this basically means that firm A pays a monthly fee to firm B, and in exchange firm B will agree to pay firm A in case that the CDO defaults or the bank or firm that holds the CDO as assets defaults. So in this sense, the firm A is swapping the default risk to firm B. The problem with this is they were sold very cheap in the expectation that banks holding the CDOs wouldn't default. AIG invested heavily in credit default swaps. So if you think of it this way, again, you have all this monthly flow of income which is coming to you, then you can actually sell that, and there's a reason, there's actually an incentive for me as a small bank or a broker with limited capital. I'm going to sell that so I don't have to wait 30 years to receive all those payments that will accumulate to me every month for 30 years. I can actually receive cash up front. That increases my capital, therefore I can maximize my leverage and actually borrow more money based on that because it increases my equity. So I pass it along to a larger bank. The larger bank then uses that as asset, which is uses that as collateral in order to borrow more money. You can think of it as a game of like hot potato or musical chairs. Think of it as a flow. It's constantly flowing though. And one of the reasons why, another question that I was asking myself was, well, if you're expecting a monthly income, how can that possibly sell for more than you're expecting to receive on the monthly income? It's a very simple question. Part of the answer has to do, let me just explain that again. Let's say I'm going to receive $1 million plus 5% interest, but it sells on the secondary markets for more than that. How is that possible if you're only expecting this certain amount of income to be accumulated, say, over 30 years? Part of the reason has to do with house flipping. We see a lot of TV shows about it that occurred. Basically, housing prices were going up. So you can assume that even if the homeowner defaulted and it was like a low risk kind of, you got the subprime or the toxic waste part of the collateral debt obligation, then you would still expect the value of the house to go up. So even if they defaulted, you collect the house, right, which is even worth more. Okay. So you collect the house as collateral, which is now worth more, and because the house prices kept going up and there had not been a nationwide decrease or devaluation of housing prices since World War II, everyone had that expectation. Housing prices go up. With the expectation that housing prices are going up, I can then sell it to someone who will pay more for it with the expectation that in the future they will get even more money coming from the mortgage owners. So I'm still trying to connect the secondary markets with the actual flow of income. They're disconnected, but ultimately they're connected at some point, at least in terms of expectations. But this created an asset bubble, which is positive feedback loop, which defies conventional economic theory. Basically, housing prices go up. The price of a commodity goes up, demand for it goes up. And that's contrary to the laws of supply and demand. Right? So quick rundown on write-downs and asset losses. So this is what's been happening recently because they've figured out that they can't really value the CDOs. No one really knows how to evaluate them or value them or put them on a market. They're supposed to put them on a mark-to-market basis, but no one knows who owns them. No one knows how much they're worth. It's really become a complicated mess. So what's been happening is the banks have had to write down their assets. So this actually creates a positive feedback loop and a spiral effect. So step one, let's say I'm a bank and I buy $100 million worth of assets. Of that $100 million, $90 million is borrowed, and I front $10 million of my own. The leverage ratio is 100 to 10 or 10. So if the value of the assets worth $100 million falls to $95 million, then the investor loses $5 million in capital, holding only $5 million remaining. So the reason why it's taken out of the $10 million rather than the $100 million is simply because you have to have some capital. You can't have all loans or debt. You have to have some equity there. So holding the leverage ratio constant at 10, this means that the investor or bank or whoever is forced to reduce the overall position to 50 million, which is 5 to 50, keeping that leverage ratio the same. which means that they have to sell $45 million in assets. Exactly when the price is low, this actually creates a negative effect where people start selling. That reduces prices, which reduces their assets that they have on the books, which means that they have to sell more. It's a constant feedback loop.